Chart of the Week with Redmayne Bentley.
You're listening to financialradio.co.uk. My name's Giles McMullen, chatting to Bill Rook from Redmayne Bentley. Bill, we're looking at crashes this week, aren't we?
Yeah. This is Giles, it's an important point we discussed just at the top of the show here, before we started, was the actual impact, the emotional impact of the market falls, and everyone gets very frightened, they get very animated about whether it's fearful for further falls or whether they're missing out on a rally. But what I'm trying to do is rationalise it and bring out a certain tool that I think is very, very useful and getting you in near where there's a trend building, and that's the 5 and the 20-day moving average crossover system. And I highlighted on this chart with the 1930 period. It's very, very tricky here with this one because there are so many points here that it happens. And in 1929 we dropped 48% in 2 months, and then we have a rally for 5-month period yielding 48%. Now we'd have caught that on the third line in on the left-hand side to the fourth line, if you can see that there. And then we have little drops here. But actually, in that period, we have 8 big drops and 8 rallies. And by the time you've had those, you might think, well, is this going wrong? Is it not? Actually, following it through, I don't think you'd have done too badly on that system. I haven't worked out exactly how much quantitatively you'd have made and lost. But where it turns red, you go short, and where you go green, you go long. I don't think you'd lost too much on the longs there. If you just have a discipline of following that, you'd have got in at the bottom. Now, the value of getting in at the bottom, or near out the bottom, we'd have actually got in on the 19th of July, 1932 at 44. The final line on the right-hand side. I'm getting in there is gold dust. Absolute gold dust, because you're looking at, between that period and 1957, an upward return of 28%, between 20 and 28% per annum. And that equates to about 1,000 to 1,200% gain in that period. And if you sold out in 1937, that would have been a 300 to 400% gain. So picking these low points is really vital to performance. And actually there's a case for actually following these, going in for crashes when things are dropping down. But again, it's sensitivity and reliability. When do you go in and not? And even with the 200-day and the 50-day crossing on the second window on from the top there on the graphic here, you'd have got out of the market at around 250, and you wouldn't have got in again till about 70 or 80. But that wasn't too bad. Yep. But actually, you missed out a lot of trading opportunities in between there.
But this is when long-term investors have to become traders, isn't it? And that can be quite nerve-wracking for them because there's so much volatility around. The buy and hold during these periods doesn't really work. I mean,
well, buy hold you use let's go back to a longer-term moving average, so like the MACD at the top of the chart there. You'd get out after you had a very good run on this market in 1920. You'd have got in about 1925 on this market and getting out at around 1929. A very good run there. That was very good. And then you would go in when the MACD goes long or when the 50 crosses the 200-day, and that was coming in at near 50 or 60 points in 1932. So that would have worked. That would have worked all right. I mean, you just have to realise that buy hold works at certain periods. When the 50 crosses the 200, you don't go in, and when the other way around, you go short on it. And but I think that catching the low points is a point here of reliability and sensitivity, and the 5 and the 20-day moving average sort of capture that in its best, I think.
So it would have worked in the 1930s. Let's have a look at the next period of market turbulence in the 70s.
Yes.
How have you applied the method here?
Well, it's a very exciting time because in 1970 we had a super plunge. We had one of the best plunges ever to look at, and to recap this plunge, Giles, this is a 57% drop in 21 months. A super time to go for it because it's straight the way down. All you're looking for is that rally coming through. Now, this one here, you're looking at a couple of signals you'd have got in 1974, 10th of October, very close to us now, isn't it, 74, we'd have got in at 639. That's the first time we've got a signal on the left-hand side. Now, we'd have got out on the 13th of November at 659 because it wasn't working. But then again, we get another signal on the 30th of December at 74, 603. Now, that is a stunning signal to have. And there aren't many systems that yield that. I mean, getting in at that point, Giles, between 580 and 610, you'll be looking, and sold in 1978, you're looking at a 27% return or 7.8% per annum, which hands down beats most interest you can get elsewhere. I mean, okay, the inflation rate was high then, but that's not bad return.
No, that sounds a very good return. Okay,
yeah.
and then One we perhaps remember a little better is what happened in 1987. And tell us how you apply it here.
Well, there's only one signal, and that's it. And that's sort of right. There's 1987. You get one on the 15th of December 87, 1903. Yes, it was lower than that and everything like that. And but it keeps you out of the market until that point comes in here. And you probably would use it. You'd actually use that use that level as if it goes below that point, you get out. And I don't think it went below that point from there. And that would have yielded a super return over the period. 87. If you got in around that level. I mean, ideally 1800, but 1903 is not bad. And you held it today, you're looking at a 19% return annually, or sort of near enough 400%. I mean, that's a stunning return. You can't really beat those returns. And there's a case for buying after these drops in the market. Whether we've got one right now is too early to tell because we haven't had the crossover of the moving averages. But it's very, very exciting when you have those solid drops and then suddenly you have a sort of V reversal. Is it happening yet? Not quite yet. And but it's we're going to keep an eye out. We're going to run the systems to see if we get a signal. We'll keep you in touch as and when these things develop. But very, very exciting times, opportunities for all investors at various levels, longer term, shorter term, and medium term investors when you have a massive correction in the market like we've just had.
So just to recap, Bill, what are you looking out for? What are you looking out for right now, and which indices are you looking at?
Well, if you're going into the market now, you're looking at tighter stocks because you don't know quite well what's going on here. You're looking at a 5 and a 20-day moving average crossover on a simple basis, both positive and negative on all equities across the board. Principally larger ones because the larger stocks recover faster than the smaller stocks. But that's the way I'd play this one. And if the doom monsters are right, we're going to have the drop down again. And if the bulls are right, it'll be sustained upside until it isn't. So that's what we're looking for.
And for those that are sort of more risk averse, although I know that there's still quite a lot of risk in these markets because of the immense volatility. I mean, could you play the tracker fund?
You could. Exactly what you do. That's exactly the right thing to do is go for the tracker funds and this sort of thing. Yeah, because tracker funds, you're not choosing individual shares. You would actually choose ICE possibly. And for those who like a bit more spice, they go for the cover call warrants when you're getting a geared effect of a market recovery or market drop. It depends exactly what you want. It's choosing an instrument to suit your personality and temperament of trading. So it's there's something for everyone. And I think principally after these big drops, I think it's very, very exciting periods for everyone. I mean, but the volatility, you're quite right, is there. It's at record levels. But also the breadth indicators suggesting on the 30-week moving averages that 1.66 was low on the Nasdaq, and that's what we're getting now. In July 2002, it was 11.9% of the number of shares above that level. So it's sort of on that metric, anything below 25% were oversold. So there's a lot of oversold indicators suggesting that we are reaching that sort of level. In the last two crashes, we've had recoveries in the second week of October. That points also to possibilities of something happening as well. That doesn't mean to say it's going to happen now, but the omens look very, very positive for an upward swing. Where to, we don't know, and when it will stop, we don't know, but while it's going, it's very, very interesting.
And just away from the charts now, Bill, I mean, there's been a lot said about what's been going on, in the city and the mood of the traders. What's your sign and your feeling? What is the mood of people out there at the moment? Well,
they'll see what they want to see. I mean, the doomsters will still see. They'll point to Dr. Andrew Weiss, who sort of thinks there's still more bad news ahead, and other people will point to sort of like Greenspan, who sees green shoots in the economy coming through. They see the housing recovery might be coming through in America, which is going to help a lot of things. So it's really key to all this is the American economy. The decoupling hasn't occurred, as other people thought they might have done. American economy is key to this. It might look coming into pre-election sort of time. It's sort of it is tricky, and but also the final quarter of the year when you have a lot of movement upwards, and there's a probability of that coming through as well. So very strongly, I mean 60. I think it's the probability of a rally this time of year from the S&P is very, very high. So all these things are stacking up in the way of actually some form of recovery. There was a lot of depression and bad news priced into the market, and I think this is probably overdone short term.
And do you think, again, sort of just away from the charts at the moment, do you think everyone's done enough, the authorities have done enough to fix this problem?
Well, there's several problems. I mean, one of the problems is the banking problem, and the next one is the recession, or potential global recession. I think recession is almost unavoidable. It's a case of how short and how long it's going to be. That's already occurring, I think, in California, and that will spread. And don't forget, California's economy is actually producing double the output of that of India. So you have to realise, put that into perspective, that this is a big economy to be going under or going into a recession. So that will come through, and I think the ramifications of that are still going to be worked out. How bad that's going to be, but the market itself is pricing in relief at the moment. There wasn't a banking crisis on top of that.
Bill Rook from Redmayne Bentley, thanks very much for joining us today and sharing your thoughts with us.
Pleasure.
Chart of the Week with Redmayne Bentley.